Another day, a bit on the downside, and we've been emphasizing it's the market leadership that's sort of flattish to down slightly in the last 7 or 8 trading days. That's happening again. So every day I put up, remember what's got us out of that December 24th bottom? Take a look here. Semiconductors down again today. Bank stocks down again today. Transports, been talking about that all day. Industrials, which is a wider part of the, includes the transports, also to the downside. These are all the leadership stocks that have been rolling over a little bit in the last 7 or 8 days. Yesterday, we had the OECD downgrading global growth, including European growth. Today, we have Mario Draghi. Also, the Fed pivot, as I like to call it. See these European stocks here? We got mostly banks down, mostly autos to the downside, and some of the big industrials like Bayer down over there. The euro notably weaker. Draghi, this is a fascinating pivot, leaving rates unchanged. Remember, the ECB was supposed to be raising interest rates this summer. That looks like it's all out the window now. They downgraded the 2019 Eurozone growth 1.1%. It was 1.7. I mean, that's a big downgrade, more than 30%. And of course, they've launched another lending program. Remember the old LTRO programs? They had 2 of them before. Now they're going to have a 3rd one to keep things cheaper. So remember what's going on here. The bar for central banks has gotten much lower than it used to be. There's no recession out there. There is some weakness that we're seeing. There's just a hint of a slowdown, and they're caving already. So we've got the Fed pivot, and now we have the ECB pivot to only a fairly modest disruption here. Let me move on to talk about the markets here. So since the end of February, we've seen some things rolling over a bit. The S&P 500, which rallied 17% from the December 24th low, is 1% below it was. But semiconductors, the Russell, banks and industrials, those were the market leadership stocks that led us out of that December 24th bottom. They've been rolling over a little bit more. So obviously, we're starting to hit the limits of what we can do with the current rally. We've talked for the last 2 weeks about how much more room would there be left to rally. The valuations are expensive. So we've got the Fed pause and the trade deal already priced in. We had tremendously cheap valuation at the end of December, 14, 15 times forward earnings, but now it's not. Now it's 16 and a half, depends on what your earnings estimates are, but it's pricey right now. The leadership is way overbought by the end of February. That's trying to correct a little bit. And the major issue is those weak global fundamentals I keep pounding away at. So what could get us out of this? How about if we get a little bit, how about if the earnings revisions that are downward stop? And this is where I think the hope is going to be for a modest rally. So on January 1st, the first quarter estimates were up 5%. It just collapsed in the next 4 or 5 weeks. By February 1st, we were flattish. By February 15th, we were negative. That's when we all started talking about earnings recessions and things like that. Today, it's down 1.3%. This is for the first quarter. Remember something, though. The rate of decline has kind of stopped now. It's slowed dramatically. And if this continues to the very end of the month, quarter's over, we will traditionally probably be positive for the month. That's because analysts are usually wrong by about 3 percentage points. Why? Because the companies are conservative in their guidance and the analysts go along with it. So if we're down 1.3% at the end of March, we will likely be up about 1.5% because of that overconfidence on the part or the concerns on the analysts going along with the big corporations and their guidance overall. So I'm hopeful that we will start seeing some more positive earnings commentary go through the middle of the year. On the other hand, if everyone comes to believe there's a recession in 2020, then all bets are off. But if there is no recession in 2020, you can very likely avoid any serious declines in the stock market later in the year. Still down right near the lows of the day, Carl, 143 points on the Dow.